resistance levels involves identifying key price points where the market is likely to reverse or pause and using these levels to inform trading decisions. Strategies such as range trading, breakout trading, and pullback trading can be employed to capitalize on these price movements. By combining these strategies with effective risk management and confirmation techniques, traders can enhance their ability to profit from market fluctuations. The market is in action. Trading trend reversals involves identifying and capitalizing on points where a market trend changes direction. This strategy requires a blend of technical analysis, patience, and discipline to accurately spot these critical junctures. Here's a detailed guide on how to effectively trade trend reversals. Firstly, identifying potential trend reversals begins with recognizing the current trend. Traders use trend lines, moving averages, and other indicators to determine if the market is in an uptrend, downtrend, or sideways movement. An uptrend is characterized by higher highs and higher lows, while a downtrend shows lower highs and lower lows. A trend reversal occurs when these patterns are disrupted, signaling a change in market sentiment. One of the most reliable tools for spotting trend reversals is the use of technical indicators and chart patterns. Indicators like the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, and Bollinger Bands can provide clues about overbought or oversold conditions, which often precede reversals. For example, if the RSI indicates an overbought condition in an uptrend, it could suggest an impending downward reversal. Similarly, chart patterns such as head and shoulders, double tops, and double bottoms are classic signals of potential reversals. A head and shoulders pattern, for instance, typically marks the end of an uptrend and the beginning of a downtrend. Candlestick patterns also play a crucial role in identifying reversals. Patterns such as the hammer, inverted hammer, engulfing patterns, and doji are often seen at the end of a trend and indicate a potential reversal. For example, a hammer candle at the bottom of a downtrend suggests that buyers are stepping in, potentially reversing the trend. Confirmation of these patterns is critical, which usually involves subsequent price action validating the reversal signal. Once a potential reversal is identified, confirmation is necessary before entering a trade. Confirmation can come in the form of a significant price movement in the opposite direction of the current trend, often accompanied by increased trading volume. For example, after identifying a head and shoulders pattern, a trader might wait for the price to break below the neckline with high volume before considering it a confirmed reversal. Risk management is paramount when trading trend reversals due to their inherently risky nature. Traders should always set stop-loss orders to limit potential losses. These stops are typically placed above resistance levels in a downtrend or below support levels in an uptrend. Additionally, position sizing should be carefully considered to ensure that any single trade does not excessively impact the overall trading portfolio. Lastly, patience and discipline are essential in trend reversal trading. It's important to wait for clear signals and confirmation before acting. Prematurely entering a trade can lead to false signals and losses. Traders should also remain flexible and ready to adjust their strategies as new market information becomes available. In summary, trading trend reversals involves recognizing current trends, using technical indicators and patterns to identify potential reversals, confirming these signals, and implementing strict risk management practices. By following these steps with patience and discipline, traders can effectively capitalize on trend reversals and enhance their trading performance. Game is on. Swing trading is a medium-term trading strategy that aims to capture price movements over several days to weeks. Unlike day trading, which involves closing all positions by the end of the trading day, swing traders hold positions for longer periods, taking advantage of market swings or price oscillations within a trend. This approach requires a balance of technical analysis, market knowledge, and timing to maximize gains while managing risks. A fundamental aspect of swing trading is identifying market trends and price patterns. Swing traders use various technical analysis tools, such as moving averages, Fibonacci retracement levels, and momentum indicators, to pinpoint potential entry and exit points. They look for signals that indicate the continuation or reversal of a trend. For instance, a swing trader might buy a stock that is bouncing off a support level or short sell a stock hitting resistance. Chart patterns like head and shoulders, flags, and double tops, bottoms are also integral to their strategy. Swing traders often combine technical analysis with fundamental analysis to increase the reliability of their trades. They might evaluate a company's earnings reports, economic data, or industry news to support their technical signals. By integrating both analytical approaches, swing traders aim to improve their chances of predicting price movements accurately. Risk management is crucial in swing trading, as positions are held for several days or weeks, exposing traders to overnight and weekend market risks. Swing traders typically use stop-loss orders to protect their capital from significant downturns. These orders automatically sell a position if it reaches a predetermined price, limiting potential losses. Position sizing is another key component, ensuring that no single trade can excessively impact the trader's portfolio. Patience and discipline are essential qualities for swing traders. Unlike scalpers or day traders who need to make quick decisions, swing traders must be willing to wait for their trade setups to materialize fully. This often involves enduring short-term market fluctuations without reacting impulsively. Staying disciplined to a trading plan and not deviating based on emotional responses is vital for success in swing trading. The flexibility of swing trading makes it suitable for individuals who cannot dedicate their entire day to monitoring the markets. It allows for a more balanced approach to trading, where decisions are made during less hectic periods. This aspect of swing trading can be particularly appealing to those with full-time jobs or other commitments. In summary, swing trading is a strategy designed to capture intermediate-term price movements within a market trend. It relies on a combination of technical and fundamental analysis to identify profitable trading opportunities. Effective risk management and a disciplined approach are essential to navigating the market's inherent volatility and achieving consistent returns. Swing trading offers a balance between the rapid pace of day trading and the long-term focus of investing, making it an attractive option for many traders. Stay informed about global economic and geopolitical developments, as they can influence market movements. Trend lines are a fundamental tool in technical analysis, used by traders to identify and confirm market trends. These lines are drawn on price charts to connect a series of highs or lows, providing a visual representation of the direction and strength of a trend. By offering insights into potential support and resistance levels, trend lines help traders make informed decisions about entry and exit points in the market. To draw a trend line, a trader begins by identifying significant peaks and troughs on a price chart. In an uptrend, the trend line is drawn by connecting a series of ascending lows, creating a support line that slopes upwards. This line suggests that as long as prices remain above it, the uptrend is likely to continue. Conversely, in a downtrend, the trend line connects descending highs, forming a resistance line that slopes downwards. This indicates that the downtrend is intact as long as prices stay below the line. Trend lines are valuable for their ability to highlight the overall direction of the market. An upward sloping trend line indicates a bullish trend, suggesting that buyers are in control and prices are likely to continue rising. A downward sloping trend line signifies a bearish trend, indicating that sellers are dominant and prices may keep falling. By identifying these trends, traders can align their strategies with the prevailing market direction, increasing the likelihood of successful trades. One of the key benefits of trend lines is their role in identifying potential support and resistance levels. In an uptrend, the trend line acts as a support level, where prices are likely to bounce back up after touching the line. This provides traders with potential entry points for long positions. In a downtrend, the trend line serves as a resistance level, where prices may face selling pressure and decline after approaching the line, offering potential entry points for short positions. Trend lines can also signal potential trend reversals. When the price breaks through a well-established trend line, it often indicates a shift in market sentiment. For example, a break below an upward sloping trend line may signal the end of an uptrend and the beginning of a downtrend. Traders use this information to exit existing positions or initiate new trades in the direction of the emerging trend. Confirming the breakout with additional technical indicators, such as volume or momentum oscillators, helps reduce the risk of false signals. In addition to their simplicity and visual clarity, trend lines are versatile and can be applied across various timeframes, from short-term intraday charts to long-term monthly charts. This flexibility allows traders to use trend lines in conjunction with other technical analysis tools to enhance their trading strategies. For instance, combining trend lines with moving averages, Fibonacci retracement levels, or candlestick patterns can provide a more comprehensive view of the market and improve decision-making. In summary, trend lines are a crucial element of technical analysis, offering valuable insights into market direction, support and resistance levels, and potential trend reversals. By drawing trend lines on price charts and using them in conjunction with other analytical tools, traders can make more informed trading decisions, align with prevailing trends, and identify optimal entry and exit points. The simplicity, versatility, and effectiveness of trend lines make them an indispensable tool for traders of all experience levels. The candles are forming. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade gold and Forex here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. Weekend gap trading is a strategy employed by traders to capitalize on price gaps that occur between the closing price on Friday and the opening price on Sunday or Monday in financial markets. These gaps are created because, while trading activities cease over the weekend, economic and geopolitical events continue to unfold, often leading to significant changes in market sentiment and asset prices by the time markets reopen. This phenomenon is particularly common in forex and stock markets, where continuous global developments can create notable discrepancies between closing and opening prices. The essence of weekend gap trading lies in predicting the direction of these gaps and positioning trades accordingly. Traders analyze a range of factors to forecast potential gaps, including economic indicators released over the weekend, political developments, natural disasters, or major news events. For instance, an unexpected election result or a natural disaster can significantly impact market sentiment, leading to a pronounced opening gap. By anticipating these events, traders can enter positions at the close of the market on Friday or at the open on Sunday or Monday to exploit the price difference. There are two primary types of gaps that traders focus on: gap up and gap down. A gap up occurs when the opening price is higher than the closing price of the previous session, while a gap down occurs when the opening price is lower. Traders use various technical analysis tools to identify potential gaps, such as support and resistance levels, trend lines, and chart patterns. Historical data and past market behavior also play a crucial role in forming gap trading strategies, as they provide insights into how similar events have impacted prices in the past. However, weekend gap trading comes with its set of risks. One significant risk is the unpredictability of market reactions to news events. Even with thorough analysis, the market's response to an event can be contrary to expectations, leading to potential losses. Additionally, the illiquid nature of the market at the opening can result in slippage, where the execution price differs from the intended price. To mitigate these risks, traders often use stop-loss orders to limit potential losses and carefully manage their position sizes. Overall, weekend gap trading can be a profitable strategy for those who can accurately anticipate market movements based on weekend events. It requires a deep understanding of global economic and political developments, proficiency in technical analysis, and a robust risk management approach. By effectively combining these elements, traders can potentially take advantage of the price discrepancies that occur as markets react to news and developments over the weekend. The gold market is playing its game. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade gold and Forex here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. Before elaborating my trading strategy, I would like to advise new traders that their first target, as a Forex trader, should be to save your capital. Once you have mastered saving your capital, then go for earning from Forex trading. And after getting the skill of earning, you should try to become rich or millionaire by Forex trading. But if you directly want to achieve third level, you can never be profitable. The Forex market is very uncertain. There is no strategy that is always 100% profitable. Risk management, proper psychology and control of emotions are the factors behind my strategy. I may be in loss, in a session or in a day, but not in a week or a month. That's how things work in the life of a Forex trader, and that's the beauty of Forex trading. The key points of my trading strategy are as under. I do semi-automated trading. It's very difficult for a human to control his psychology and emotions during trading in highly volatile market of Forex. That's why I believe software tools are necessary in Forex trading. I use hybrid approach in my trading that involves human input as well as my own developed expert advisor, EA, algorithm to hint for best entries in trendy and sideways market, keeping in view the running fundamentals of the market. My EA doesn't follow the direction of any daily technical analysis, but looks for suitable entries in both directions, sell and buy. The TP, SL and break-even settings are performed by the EA bot. That really makes my work easy. I constantly keep on improving my EA to improve its performance. I trade all sessions. No doubt, there is more trading volume in the market during New York session and during sessions overlapping. However, good opportunities can come anytime. That's why I love to trade all sessions, looking for nice entries. I take multiple positions in same direction. Whenever I found a suitable entry, I run multiple positions of same lot size and same stop loss, but with different take profits. One of these positions will have open TP, in order to take maximum benefit from big market moves. Sometimes my SLs may trigger in a row, but these net SLs are much smaller than my net TPs. That's what makes me profitable. I do break even of remaining positions after 1 or 2 TP hits. In my trading, when 1 or 2 TPs are hit, I move SLs of all other running positions to break-even level. This may deprive me of taking benefit from my entry, if market retests my entry level and then bounces back in my direction. In this case, I don't take next entry in same direction. I'll wait, and the waiting period sometimes may extend even up to a couple of hours or so, until I found an opportunity in opposite direction. Then I will take my next entry. Light discussion goes on. Fundamental analysis is a method of evaluating financial markets, including Forex, by analyzing economic, social, and political factors that influence currency prices. This approach focuses on understanding the underlying factors driving currency value and predicting how these factors will affect future market movements. Fundamental analysis provides a comprehensive view of a currency's potential by examining various economic indicators, central bank policies, political stability, and market sentiment. One key component of fundamental analysis is the study of economic indicators. These include metrics such as gross domestic product, GDP, employment data, inflation rates, and interest rates. GDP measures the total economic output of a country, with strong GDP growth usually indicating a healthy economy and a potentially stronger currency. Employment data, including the unemployment rate and non-farm payrolls, can also signal economic health. Higher employment levels typically support a stronger currency. Inflation rates, measured by indicators like the Consumer Price Index, CPI, and Producer Price Index, PPI, impact currency value by affecting purchasing power. Moderate inflation is generally positive, but high inflation can weaken a currency. Interest rates, set by a country's central bank, are crucial as higher rates attract foreign investment, increasing demand for the currency. Central bank policies play a significant role in fundamental analysis. Central banks, such as the Federal Reserve, European Central Bank, and Bank of Japan, influence currency values through monetary policy. Actions like raising interest rates or reducing the money supply can strengthen a currency, while lowering interest rates or increasing the money supply can weaken it. Statements and meeting minutes from central banks provide insights into future monetary policy decisions, which influence market expectations and currency movements. Political stability and economic performance are also critical factors. Political events, such as elections, government policies, and geopolitical tensions, can significantly impact currency values. A stable political environment generally favors a currency, whereas instability can lead to depreciation. Economic performance indicators, such as trade balances, fiscal policies, and foreign direct investment, also affect currency strength. For instance, a trade surplus, where exports exceed imports, can boost a currency, while a trade deficit can weaken it. Market sentiment and news are integral to fundamental analysis. Market sentiment reflects the overall attitude of investors towards a particular currency and is influenced by news events, economic reports, and geopolitical developments. Positive sentiment can drive currency appreciation, while negative sentiment can lead to depreciation. Real-time news sources and economic calendars are essential tools for tracking events that can impact currency markets. The process of fundamental analysis involves several steps. First, traders gather and analyze economic data from reliable sources such as government reports, central bank releases, and financial news outlets. Understanding the context of this data is crucial, as it requires considering the broader economic environment and historical trends. For example, understanding how current inflation rates compare to historical averages can provide insights into potential future central bank actions. Using this information, traders forecast future currency movements, such as anticipating an appreciation if indicators suggest an upcoming interest rate hike. Finally, traders make informed trading decisions based on their analysis, often combining fundamental analysis with technical analysis to identify optimal entry and exit points. Fundamental analysis offers several advantages. It provides a comprehensive understanding of the factors driving currency value and helps anticipate long-term market trends based on economic fundamentals. This method is particularly useful for making informed decisions during significant economic events. However, fundamental analysis can be complex and time-consuming due to the vast amount of data to analyze. Market reactions to economic data can be unpredictable and influenced by short-term sentiment, and a deep understanding of global economics and geopolitical factors is required. In conclusion, fundamental analysis is a powerful tool for forex traders, enabling them to make informed decisions based on economic and political factors that influence currency values. By staying informed about key economic indicators, central bank policies, and global events, traders can anticipate market movements and develop strategies to capitalize on them. Combining fundamental analysis with technical analysis can further enhance trading effectiveness, providing a well-rounded approach to navigating the forex market. The gold market is going on. Backtesting trading strategies is a crucial step in the development and refinement of any trading system. It involves applying a trading strategy to historical market data to evaluate its performance over time. By simulating trades that would have occurred in the past, traders can gain insights into the potential effectiveness and profitability of their strategies without risking real capital. The process of backtesting starts with the selection of a trading strategy. This strategy includes specific rules for entering and exiting trades, position sizing, and risk management. Once the strategy is defined, it is applied to historical data to simulate how it would have performed under actual market conditions. This helps traders identify whether the strategy can generate consistent returns and withstand various market scenarios. One of the primary benefits of backtesting is that it allows traders to validate their strategies before committing real money. By testing a strategy on past data, traders can identify potential flaws and make necessary adjustments. This process helps in refining the strategy to enhance its performance and robustness. Additionally, backtesting provides statistical measures such as win rate, average profit, loss, maximum drawdown, and Sharpe ratio, which are essential for evaluating the risk and return profile of the strategy. Backtesting also helps traders understand the historical context and behavior of their strategies. For example, a strategy that performs well in a trending market may not fare as well in a sideways or choppy market. By analyzing historical performance, traders can identify the market conditions under which their strategies perform best and make informed decisions about when to deploy them. This contextual understanding is crucial for adapting strategies to changing market environments. Moreover, backtesting facilitates the optimization of trading strategies. Traders can test various parameters and settings to find the optimal combination that maximizes returns and minimizes risks. For instance, they can adjust the time frames, technical indicators, or stop-loss levels to see how these changes impact the strategy's performance. Optimization helps in fine-tuning the strategy to achieve better results, but it must be done carefully to avoid overfitting, where a strategy performs well on historical data but fails in live markets due to excessive customization. Lastly, backtesting builds confidence in a trading strategy. When traders see consistent and favorable results from backtesting, they are more likely to trust and stick to their strategies during live trading. This confidence is crucial for maintaining discipline, especially during periods of drawdown or market volatility. It reassures traders that their strategies have been rigorously tested and are likely to yield positive outcomes over the long term. In summary, backtesting trading strategies is an essential practice that helps traders validate, refine, and optimize their strategies using historical data. It provides valuable insights into the strategy's performance, helps identify optimal settings, and builds confidence in its application. By thoroughly backtesting their strategies, traders can enhance their chances of success in the dynamic and unpredictable world of trading. Our expert advisor is active. The risk-reward ratio is a fundamental concept in trading that helps traders assess the potential profitability of a trade relative to its potential loss. It is calculated by dividing the potential profit, reward, of a trade by the potential loss, risk. The best risk-reward ratio depends on a trader's strategy, risk tolerance, and market conditions, but understanding and applying this concept is crucial for long-term trading success. A commonly recommended risk-reward ratio is 1 to 2, meaning that for every dollar risked, the potential reward should be $2. This ratio ensures that even if a trader only wins 50% of their trades, they can still be profitable. For instance, if a trader risks $100 on a trade with the potential to make $200, they need to win only half of their trades to break even or be profitable. This approach encourages disciplined trading and helps traders maintain a positive expectancy over time. However, the optimal risk-reward ratio can vary based on the trader's style and strategy. Scalpers, who execute numerous trades within a short period, might work with lower risk-reward ratios, such as 1 to 1 or 1 to 1.5, due to the high frequency of trades and smaller profit targets. On the other hand, swing traders and position traders, who hold trades for longer periods, might aim for higher risk-reward ratios like 1 to 3 or 1 to 4, capitalizing on larger price movements and trends. The selection of the best risk-reward ratio also depends on the accuracy or win rate of the trading strategy. A strategy with a high win rate can afford a lower risk-reward ratio because the frequent small profits can outweigh occasional losses. Conversely, a strategy with a lower win rate requires a higher risk-reward ratio to remain profitable. For example, a strategy with a win rate of 40% might need a risk-reward ratio of 1 to 3 to ensure that the wins cover the losses and provide overall profitability. Implementing a favorable risk-reward ratio requires careful planning and discipline. Traders should establish clear entry and exit points for each trade, setting stop-loss and take-profit orders to manage risk and reward effectively. By determining these levels in advance, traders can avoid emotional decision-making and adhere to their trading plan. Additionally, consistently applying a predetermined risk-reward ratio helps traders evaluate and refine their strategies over time. It is also essential to consider market conditions when determining the best risk-reward ratio. Volatile markets may offer more significant profit opportunities but also carry higher risks, potentially justifying higher risk-reward ratios. In contrast, stable markets might require more conservative ratios due to limited price fluctuations. Traders should adapt their risk-reward approach to the current market environment to optimize their chances of success. In summary, the best risk-reward ratio in trading is subjective and varies based on the trader's style, strategy, risk tolerance, and market conditions. While a 1 to 2 ratio is a common starting point, traders must tailor their risk-reward ratios to fit their specific trading approach and objectives. By consistently applying a suitable risk-reward ratio, traders can enhance their profitability and ensure a disciplined, strategic approach to the markets. Light discussion on various aspects of trading, from risk management to mindset and strategy, that are of great value to everyone, especially new traders. Successful Forex trading requires discipline, a solid strategy, and consistent habits. Developing these habits can enhance your trading skills and increase your chances of long-term success in the market. Continuous education. One of the best habits for a Forex trader is to continuously educate yourself. Stay updated with market news, economic reports, and geopolitical events that can affect currency movements. Regularly read books, attend webinars, and follow credible sources to improve your knowledge and skills. Continuous education ensures that you stay informed about the latest developments in the market and adapt your strategies accordingly. Developing and sticking to a trading plan. A well-defined trading plan is essential. Outline your trading goals, risk tolerance, and preferred trading strategies. Specify entry and exit points, risk management rules, and position sizing guidelines. Having a trading plan helps maintain discipline and consistency in your trading activities. It also prevents impulsive decisions based on emotions or market noise. Effective risk management. Implementing effective risk management techniques is crucial. Always use stop-loss orders to limit potential losses and never risk more than a small percentage of your trading capital on a single trade, typically 1 to 2%. This approach protects your capital and ensures that a few losing trades do not significantly impact your overall trading account. Proper risk management is the cornerstone of sustainable trading. Maintaining a trading journal. Keeping a trading journal is another valuable habit. Record all your trades, including the rationale behind each trade, entry and exit points, and outcomes. Regularly review your journal to identify patterns, strengths, and areas for improvement. A trading journal provides insights into your trading behavior and helps refine your strategies over time. Practicing patience and discipline. Patience and discipline are key traits of successful traders. Stick to your trading plan and avoid impulsive decisions driven by emotions. Wait for the right trading opportunities that align with your strategy. Patience ensures that you do not enter trades prematurely, and discipline helps you follow your plan without deviation. Staying updated with market conditions. Keep abreast of market conditions by monitoring economic indicators, central bank announcements, and political events that can influence the forex market. Use a reliable economic calendar to track important events. Staying informed about market conditions allows you to anticipate potential market movements and adjust your strategies accordingly. Diversifying your portfolio. Diversification is a fundamental risk management strategy. Avoid putting all your capital into a single currency pair. Instead, diversify your trades across different currency pairs and possibly other asset classes to spread risk. Diversification helps mitigate the impact of adverse movements in any single market. Utilizing technology and tools. Leverage technology and tools to enhance your trading. Use technical analysis tools, such as charts and indicators, to make informed trading decisions. Consider using automated trading systems or bots to execute trades based on predefined criteria. Technology can improve your trading efficiency and accuracy. Controlling emotions. Controlling your emotions is critical for consistent trading performance. Avoid letting fear, greed, or overconfidence dictate your trading decisions. Practice mindfulness or meditation to stay calm and focused. Emotional control helps maintain objectivity and prevents rash decisions that can lead to losses. Staying healthy. Maintaining a healthy lifestyle is often overlooked but essential for trading success. Regular exercise, a balanced diet, and adequate sleep contribute to mental and physical well-being. A healthy body and mind enhance your ability to make sound trading decisions and sustain long trading sessions. Regularly reviewing and adapting your strategy. Continuously evaluate the effectiveness of your trading plan and strategies. Be willing to adapt and make necessary adjustments based on your performance and changing market conditions. Regular review and adaptation ensure that your strategies remain relevant and effective. Networking with other traders. Engage with trading communities, forums, or groups to share insights, strategies, and experiences. Networking with other traders can provide valuable perspectives and improve your trading skills. Learning from others and discussing different approaches can enhance your understanding of the market. By developing and consistently practicing these habits, you can enhance your forex trading skills and increase your chances of long-term success in the market. Gold is moving. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade gold and Forex here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. The Bank of England, BOE, has a long and significant relationship with gold, playing a pivotal role in the global gold market. Established in 1694, the BOE has historically been one of the key institutions in managing gold reserves, both for the United Kingdom and other countries. Its gold vaults are among the largest and most secure in the world, housing not only the UK's gold reserves but also substantial holdings for various other central banks and international organizations. The BOE's role in gold began to solidify in the 19th century with the establishment of the gold standard. Under the gold standard, the value of the British pound was directly linked to a specific quantity of gold, and the BOE was responsible for maintaining this parity. This system provided a stable currency exchange environment, which facilitated international trade and economic stability. Although the gold standard was eventually abandoned in the early 20th century, the BOE continued to manage significant gold reserves. Today, the Bank of England remains a key player in the global gold market primarily through its custodial services. The BOE offers secure storage facilities for gold bars in its underground vaults, which are renowned for their security. These vaults are located deep below the streets of London and contain hundreds of thousands of gold bars, making it one of the largest repositories of gold in the world. The BO provides custodial services not only for the UK but also for numerous foreign central banks and international financial institutions, ensuring the safety and integrity of their gold holdings. In addition to storage, the BO facilitates the trading of gold. It acts as an intermediary for gold transactions, leveraging its reputation and infrastructure to ensure that trades are executed smoothly and securely. This role is crucial in maintaining the liquidity and efficiency of the gold market. The bank also plays a part in the London bullion market, one of the world's major gold trading centers, by helping to set standards and practices that govern the trading and settlement of gold. The BO's gold reserves serve as an important financial buffer and a means of diversifying the national reserves. Gold is seen as a hedge against inflation and currency devaluation, providing financial stability in times of economic uncertainty. The BO periodically reviews its gold holdings as part of its broader strategy to manage the UK's foreign exchange and reserve assets. Furthermore, the Bank of England's involvement in the gold market extends to policy influence. Through its actions and communications, the BO can impact gold prices and market perceptions. For instance, decisions on interest rates and monetary policy, while primarily aimed at controlling inflation and supporting economic growth, can indirectly affect gold prices. A lower interest rate environment, often associated with a weaker currency, can lead to higher gold prices as investors seek safe haven assets. In summary, the Bank of England plays a multifaceted role in the global gold market, from serving as a secure custodian and facilitator of gold trading to influencing market conditions through its monetary policies. Its historical and ongoing involvement underscores the importance of gold in global finance and the trust placed in the BO by countries and institutions worldwide. The expert advisor is working. Using bots in forex and gold trading offers several benefits, which can significantly enhance trading efficiency, accuracy, and overall profitability. These automated trading systems leverage advanced algorithms to execute trades based on predefined criteria, providing several advantages over manual trading. One of the primary benefits of using bots in trading is their ability to operate 24/7 without the limitations of human fatigue or emotions. Financial markets, especially forex, operate continuously throughout the week, and bots can monitor and execute trades at any time, ensuring that no trading opportunities are missed due to human unavailability. This constant vigilance is particularly advantageous in highly volatile markets where prices can change rapidly. Bots also excel in executing trades with speed and precision. They can analyze vast amounts of data and respond to market movements in milliseconds, far faster than any human could. This speed is crucial in forex and gold trading, where even slight delays can result in missed opportunities or suboptimal entry and exit points. By ensuring timely execution, bots can help traders capture favorable market conditions more effectively. Another significant benefit is the elimination of emotional biases from trading decisions. Human traders often fall prey to emotions such as fear, greed, and impatience, which can lead to irrational decisions and significant losses. Bots operate purely on logic and predefined strategies, maintaining discipline and consistency in their trading approach. This objective decision-making process can lead to more reliable and steady performance over time. Bots also provide the advantage of backtesting and optimization. Traders can test their strategies on historical data to assess their viability before deploying them in live markets. This backtesting capability allows for fine-tuning and optimizing trading algorithms to improve performance and reduce risks. By refining strategies based on historical performance, traders can increase their confidence in the bot's ability to handle various market conditions. Additionally, bots can manage multiple trading accounts and strategies simultaneously, offering scalability and diversification. This capability allows traders to spread their risk across different markets and strategies, enhancing their overall portfolio performance. Automated systems can also adjust their strategies dynamically based on changing market conditions, providing a level of adaptability that can be challenging to achieve manually. In conclusion, the use of bots in forex and gold trading brings numerous benefits, including round-the-clock operation, rapid and precise trade execution, elimination of emotional biases, and the ability to backtest and optimize strategies. These advantages can lead to more disciplined, consistent, and potentially more profitable trading outcomes, making bots an invaluable tool for modern traders. the market is active. In trading, breakouts and false breakouts are critical concepts that can significantly impact a trader's strategy and success. Understanding the difference between the two and knowing how to identify and manage them can help traders make more informed decisions and avoid costly mistakes. A breakout occurs when the price of an asset moves decisively beyond a key support or resistance level, usually accompanied by increased volume. This movement signals a potential continuation of the trend in the direction of the breakout. For instance, if a stock has been trading below a resistance level of $50 and then surges above it with strong volume, it is considered a breakout. Breakouts are significant because they indicate a shift in market sentiment, often leading to substantial price movements as new trends form and traders and investors enter the market. Breakouts can provide lucrative trading opportunities. To trade breakouts effectively, traders often look for confirmation signals, such as a close above the resistance level or below the support level, along with high trading volume. This confirmation helps validate the breakout and reduces the likelihood of entering a trade based on a false signal. Additionally, traders may use other technical indicators, such as moving averages or momentum oscillators, to corroborate the breakout signal. False breakouts, on the other hand, occur when the price temporarily moves beyond a support or resistance level but then quickly reverses direction, failing to sustain the new trend. This can trap traders who entered positions based on the apparent breakout, leading to losses as the price retreats back within the previous range. False breakouts often occur due to low volume, lack of follow-through, or market manipulation, where large players push prices beyond key levels to trigger stop orders and then reverse the direction. To avoid false breakouts, traders should employ several strategies. Firstly, waiting for confirmation is crucial. Instead of entering a trade as soon as the price breaches a support or resistance level, traders should wait for the price to close beyond the level and confirm the breakout. Monitoring volume is also essential, as true breakouts are typically accompanied by a significant increase in volume, indicating genuine buying or selling interest. Low volume during a breakout can be a red flag for a potential false breakout. Using additional technical indicators can also help filter out false breakouts. For example, a trader might look for a bullish crossover in the Moving Average Convergence Divergence (MACD) indicator or an overbought signal in the Relative Strength Index (RSI) to confirm a breakout to the upside. Similarly, bearish signals can confirm a breakdown below support. Risk management is vital when trading breakouts to mitigate the impact of false breakouts. Traders should set stop-loss orders to limit potential losses if the breakout turns out to be false. Placing stop-loss orders just below the support level for long positions or just above the resistance level for short positions can help protect against adverse price movements. Additionally, position sizing should be adjusted to ensure that any single trade does not overly impact the trader's overall portfolio. In summary, breakouts and false breakouts are important concepts in trading that can influence the success of a strategy. Breakouts signal potential new trends and offer trading opportunities, while false breakouts can lead to losses if not properly identified and managed. By waiting for confirmation, monitoring volume, using additional technical indicators, and employing robust risk management practices, traders can enhance their ability to distinguish between genuine breakouts and false signals, improving their overall trading performance. Our expert advisor is analyzing candles formed by the market. Gold's high volatility offers numerous opportunities for traders to profit, provided they adopt the right strategies and risk management techniques. One effective approach is to engage in short-term trading strategies, such as day trading or swing trading, which allow traders to capitalize on the frequent price fluctuations within a day or over several days. By closely monitoring gold's price movements and employing technical analysis tools like moving averages, Bollinger Bands, and the Relative Strength Index, RSI, traders can identify potential entry and exit points. These tools help in predicting trend reversals or continuations, thus facilitating timely trades. Another method to leverage gold's volatility is through options trading. Options give traders the right, but not the obligation, to buy or sell gold at a predetermined price within a specified time frame. This can be particularly advantageous in volatile markets, as it allows traders to benefit from price swings without the need to hold the physical asset. Strategies such as straddles and strangles, which involve buying both call and put options, can be effective in capturing gains regardless of the direction in which gold prices move. The key is to anticipate significant price movements and structure option trades that can profit from such volatility. Additionally, using leveraged products like gold futures and leveraged ETFs, exchange-traded funds, can magnify potential returns from gold's price movements. These financial instruments allow traders to gain larger exposure to gold prices without needing to invest a large amount of capital upfront. However, it's crucial to manage the inherent risks associated with leverage, as it can also amplify losses. Traders should implement strict risk management practices, such as setting stop-loss orders and maintaining appropriate position sizes, to protect their capital. Furthermore, keeping abreast of global economic events and geopolitical developments is vital. Gold prices are highly sensitive to macroeconomic indicators, central bank policies, inflation rates, and geopolitical tensions. By staying informed about these factors, traders can anticipate periods of high volatility and adjust their trading strategies accordingly. For instance, during times of economic uncertainty or political unrest, gold often sees increased demand as a safe haven asset, leading to significant price movements. In summary, traders can take advantage of gold's high volatility by employing short-term trading strategies, using options and leveraged products, and staying informed about global economic and geopolitical developments. Effective risk management is essential in all these approaches to safeguard against potential losses and to ensure sustainable trading success. Gold is in move. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade gold and forex here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. In the realm of forex and gold trading, brokers play a crucial role by providing platforms and services that enable traders to buy and sell currencies and precious metals. There are several types of brokers catering to different trading needs and preferences. Understanding these types can help traders choose the broker that best aligns with their trading strategies and objectives. The first type of broker is the market maker. Market makers create a market for traders by setting bid and ask prices and standing ready to buy or sell at those prices. They essentially act as counterparties to traders' transactions, which means that they can provide liquidity even when there are no immediate buyers or sellers in the market. Market makers often offer fixed spreads, which can be beneficial for traders looking for price certainty. However, since they are the counterparty to trades, there can be potential conflicts of interest, as the broker may benefit from traders' losses. Another type of broker is the Electronic Communication Network, ECN, broker. ECN brokers connect traders directly with other participants in the market, such as banks, financial institutions, and other traders. This means that traders can get access to the best bid and ask prices available in the market, which often results in tighter spreads. ECN brokers typically charge a commission on trades instead of widening the spread. This type of broker is ideal for traders who prefer transparency and direct market access, particularly those who employ high-frequency or scalping strategies. Straight-through processing, STP, brokers are similar to ECN brokers in that they route traders' orders directly to liquidity providers. However, STP brokers do not necessarily match orders with other traders but rather send them to their pool of liquidity providers, which can include banks and other brokers. STP brokers may offer variable spreads depending on the liquidity available from their providers. This type of broker provides a more seamless trading experience and can be a good choice for traders who value direct access to market liquidity without the potential conflicts of interest seen with market makers. For traders focusing on gold trading, some brokers specialize as commodity brokers. These brokers provide platforms that facilitate trading in various commodities, including gold. They offer access to gold futures, options, and spot markets. Commodity brokers often provide specialized tools and research that cater specifically to commodity traders. They are suitable for those who require detailed market analysis and hedging options in the commodities space. Finally, multi-asset brokers offer a wide range of trading instruments, including forex, gold, stocks, indices, and other commodities. These brokers cater to traders looking for diversification across different asset classes from a single platform. Multi-asset brokers typically offer comprehensive trading tools and resources, making them suitable for traders who want to manage a diverse portfolio. In summary, the choice of a forex and gold trading broker depends on the trader's specific needs and trading style. Market makers provide liquidity and fixed spreads, while ECN and STP brokers offer direct market access with potentially tighter spreads. Commodity brokers specialize in the gold market, and multi-asset brokers provide a wide range of trading instruments. Understanding the differences between these brokers can help traders select the right partner for their trading endeavors. Light discussion goes on. Forex trading can be facilitated through either traditional brokers or proprietary trading firms, prop firms, each offering distinct advantages and disadvantages depending on a trader's goals, experience, and resources. Understanding the differences between these two options can help traders make informed decisions about where to direct their trading efforts. Forex brokers provide individual traders with the platform and resources to trade currencies in the Forex market. Brokers typically offer a range of trading accounts, from standard to ECN, electronic communication network, accounts, catering to both retail and professional traders. They provide access to various trading tools, educational resources, and customer support, which can be particularly beneficial for novice traders. Brokers earn through spreads, the difference between bid and ask prices, or commissions on trades. This model allows traders to maintain control over their capital, strategies, and risk management. However, trading with brokers requires personal capital, and the potential for loss is directly borne by the trader. In contrast, proprietary trading firms, prop firms, operate differently by allowing traders to trade the firm's capital rather than their own. This setup significantly reduces the financial risk for traders while providing the opportunity to earn a share of the profits. Prop firms usually require traders to pass a rigorous evaluation process to demonstrate their trading skills and discipline. Successful candidates gain access to the firm's capital and resources, such as advanced trading platforms, professional development programs, and mentorship. This model is particularly attractive to skilled traders who lack sufficient personal capital but possess the expertise to generate consistent returns. One of the main advantages of trading with a prop firm is the leverage provided by the firm's capital. Traders can take larger positions than they could with their funds, potentially leading to higher profits. Additionally, prop firms often cover the operational costs, including trading platforms and data feeds, which can otherwise be significant for individual traders. The support and structured environment of a prop firm can also enhance a trader's performance and discipline, thanks to the access to seasoned professionals and a collaborative trading environment. However, trading with prop firms comes with its own set of challenges. The evaluation process to join a prop firm can be stringent, with a focus on risk management and consistency rather than just profitability. Traders may face pressure to meet performance targets and adhere to the firm's risk management policies, which can limit trading flexibility. Furthermore, profit splits between the trader and the firm mean that traders do not retain the full earnings of their successful trades, unlike in personal accounts with brokers. In summary, choosing between a Forex broker and a prop firm depends largely on a trader's individual circumstances and goals. Forex brokers offer autonomy and full control over trading strategies and profits but require personal capital and bear the full risk of losses. Prop firms, on the other hand, provide the opportunity to trade with substantial capital and professional support, reducing personal financial risk but often at the cost of profit sharing and adherence to strict performance criteria. Traders must weigh these factors to determine which option best suits their trading style and financial objectives. Gold is doing its work. China's relationship with gold is multifaceted and strategically significant, reflecting its economic aspirations and historical affinity for the precious metal. As one of the world's largest producers, consumers, and holders of gold, China plays a pivotal role in the global gold market. China is the largest producer of gold globally, with extensive mining operations spread across the country. The Chinese government has encouraged domestic gold production to reduce reliance on foreign sources and to support the local economy. The development of the gold mining industry is part of China's broader strategy to strengthen its position in the global commodities market. This robust production capacity ensures that China has a steady supply of gold, bolstering its reserves and contributing to its economic stability. On the consumption side, China is also the largest consumer of gold, driven by both cultural and economic factors. Gold holds a significant place in Chinese culture, symbolizing wealth, prosperity, and good fortune. This cultural affinity is evident in the high demand for gold jewelry, particularly during festivals and weddings. Additionally, Chinese investors view gold as a safe haven asset, especially in times of economic uncertainty or when there are concerns about the stability of the financial system. This dual demand from both the retail and investment sectors underscores the importance of gold in the Chinese economy. The People's Bank of China, PBOC, China's central bank, plays a crucial role in managing the country's gold reserves. Over the past decade, the PBOC has significantly increased its gold holdings as part of a strategy to diversify its foreign exchange reserves and reduce reliance on the US dollar. By holding substantial gold reserves, the PBOC aims to enhance China's financial security and stability. These reserves act as a buffer against economic volatility and potential currency devaluation. The PBOC's consistent accumulation of gold has also been interpreted as a move to bolster the yuan's credibility and facilitate its acceptance as a global reserve currency. In addition to managing reserves, China has developed a sophisticated gold trading infrastructure. The Shanghai Gold Exchange, SGE, is one of the largest gold exchanges in the world, providing a transparent and regulated marketplace for gold trading. The SGE has introduced several initiatives to internationalize gold trading, including the establishment of the Shanghai Free Trade Zone, which allows foreign investors to trade gold on the exchange. These efforts are part of China's broader strategy to exert greater influence over the global gold market and to promote the yuan in international transactions. China's Belt and Road Initiative, BRI, also has implications for the gold market. As part of this extensive infrastructure and economic development project, China is investing in numerous countries that are significant gold producers. These investments often include the development of mining projects, which can increase China's influence over global gold supplies and enhance its strategic interests. Moreover, China's approach to gold reflects its long-term economic strategies. By accumulating gold, promoting its domestic market, and enhancing its trading infrastructure, China aims to safeguard its economic interests and assert its influence in the global financial system. This strategic orientation towards gold is consistent with China's broader goals of achieving economic resilience and reducing vulnerability to external economic shocks. In summary, China's involvement with gold is comprehensive, encompassing production, consumption, reserve management, and trading infrastructure. The country's strategic approach to gold underscores its importance in China's economic policy and its efforts to enhance financial stability and global influence. This multifaceted engagement makes China a key player in the global gold market, with significant implications for global economic dynamics. The expert advisor is doing its work. Daily gold production is a crucial metric in the global supply of this precious metal, influencing its market price and availability. On average, the world produces approximately 3,000 metric tons of gold annually, translating to roughly 8.2 metric tons per day. However, this figure can vary significantly based on several factors, including mining conditions, technological advancements, regulatory changes, and economic factors. Gold production is predominantly driven by a handful of leading gold-producing countries. Nations such as China, Australia, Russia, and the United States are among the top contributors to daily gold output. These countries benefit from extensive mining infrastructure, rich geological deposits, and, in many cases, supportive regulatory environments. For instance, China, the largest producer, accounts for about 10 to 15% of global daily production, with its extensive mining operations and advanced technology playing a critical role. The daily production of gold is also influenced by the type of mining operations. Large-scale industrial mining projects, which include open-pit and underground mines, contribute the majority of daily output. These operations rely on advanced machinery and technology to extract gold efficiently and at high volumes. In contrast, artisanal and small-scale mining, ASM, which is prevalent in regions like Africa and South America, contributes a smaller portion to daily production but is significant in local economies and communities. Market conditions and gold prices also impact daily gold production. When gold prices are high, mining companies are incentivized to increase production to capitalize on the favorable market conditions. Conversely, when prices are low, some operations may scale back production or temporarily shut down, reducing daily output. Additionally, the cost of production, which includes factors such as labor, energy, and materials, can influence the volume of gold mined each day. Environmental and regulatory factors play a crucial role in daily gold production. Stricter environmental regulations and sustainable mining practices can affect the speed and volume of gold extraction. Companies are increasingly required to implement measures to minimize environmental impact, which can sometimes slow down production processes. Regulatory changes in major gold-producing countries can also lead to fluctuations in daily production levels, depending on how favorable or restrictive the new policies are. In summary, daily gold production is a dynamic and multifaceted process influenced by geographical, technological, economic, and regulatory factors. Understanding these elements provides insight into the complexities of gold supply and its impact on global markets. Forex trading. is not gambling at all. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade gold and forex here, and alongside that, I engage in light discussions on various aspects of trading that is of great value to everyone, especially new traders. The daily trading volume in the forex, foreign exchange, market is among the highest of any financial market in the world. On average, the forex market sees a daily trading volume of over $6 trillion. This immense volume reflects the global nature of currency trading, involving a vast array of participants including banks, financial institutions, corporations, governments, and individual investors. The forex market operates 24 hours a day, 5 days a week, across major financial centers like London, New York, Tokyo, and Sydney, contributing to its high liquidity and continuous activity. The major currency pairs, such as Euro, USD, JPY, and GBP, USD, account for a significant portion of this daily volume. The high trading volume in these pairs is driven by their liquidity, tight spreads, and the substantial economic activities of the countries involved. Additionally, the forex market's decentralized nature means that trading occurs over the counter, OTC, through a network of banks and brokers, facilitating extensive trading activity around the clock. In contrast, the daily trading volume of gold, while substantial, is significantly lower than that of the forex market. On average, the gold market sees a daily trading volume of around $145 billion. This volume includes trading on various exchanges such as the London Bullion Market, the largest global center for over-the-counter gold trading, the COMEX in New York, the leading futures market for gold, and other regional exchanges. The gold market's trading volume is driven by various participants, including central banks, institutional investors, hedge funds, and retail investors. Gold is traded in several forms, including physical gold, bars and coins, futures contracts, options, and exchange-traded funds, ETFs. Each of these forms caters to different types of investors, from those seeking physical ownership to those looking to speculate on price movements or hedge against economic uncertainties. Gold trading is influenced by factors such as economic data releases, geopolitical events, and movements in other markets like currencies and equities. Its status as a safe haven asset means that demand can surge during periods of market turmoil or geopolitical instability, leading to higher trading volumes. Conversely, in more stable times, the volume may decrease as investors shift their focus to other assets. In summary, while the daily trading volume of gold is substantial at around $145 billion, it pales in comparison to the forex market's staggering $6 trillion. The forex market's vast volume reflects its global, decentralized, and highly liquid nature, whereas gold trading, despite being significant, is more specialized and influenced by specific economic and geopolitical factors. Both markets play crucial roles in the global financial system, offering unique opportunities for various types of investors.
කියන්නේ මාකට් එක සුද්ධ සිංහලෙන් අපිට පේනවා. හරි. ඔන්න තව ටීවී එකක් ගැහුවා. කියන්නේ හරි. තව ටීවී එකක් ගැහුවා කියන්නේ තොකොට ෂෝට් එකේ TP එක. guys මොනවද තමයි ස්ට්‍රැටජි එක මගේ. okay. ස්නයිපර් එන්ට්‍රි. හරි. ඉතින් ස්නයිපර් එන්ට්‍රි වලට බය නම් මේ ඉන්ඩිකේටර් විතරක් ගන්න. okay. මම හිතනවා ඔයාලට තේරුණා කියලා. අද දවසේ පොඩි දෙයක් මම මේ කියලා දුන්නේ. කෝල්ඩ් එකේ. හරි. ඉතින් අපි යන් පොඩ්ඩක් ඉන්න BTC එකකට. ඕකේ. අපි බලමු BTC මොකද කරලා තියෙන්නේ කියලා. අතරින් නැහැ BTC. wow guys what a entry 1 minute එකේ මම ඉන්නේ guys. okay. ඉතින් RSI එකෙන් ට්‍රේඩ් ගන්න ඉන්නවනම් ට්‍රේඩ් ගන්න කට්ටිය හිටියනම් අනිවාර්යෙන් ලොස් වෙනවා guys. ඒකට තමයි මේ එම්පයර් එකේ මේ ඉන්ඩිකේටර් එක සුපර් කියලා කියන්නේ. ඔයාලා බලන්න මෙතනින් බයි එකක් දීලා තියෙනවා. okay. මෙතනින් RSI කී පාරක් මෙතන ඕබොට් ගියද මෙතන එක පාරක් ගියද උඩරින්ම ඒත් ඉතින් ෂෝට් උන්න.
The market is in motion.
හැබැයි මාකට් එක ලස්සනටම ඩවුන් වෙලා තියෙනවා. ඔන්න TP එකකුත් දීලා තියෙනවා. සුපර් රේට් එකක් කරන් තියෙනවා guys. BTC මාකට් එකේ දැන් BTC price එක 107k. okay. අපි යම් 4 hours එකට BTC. මගේ live එකකින් ඉන් කරන්න කලින්. okay. ඉතින් කතන්දරේ හැටියට 4 hours එකේ swing trade එකේ කතන්දරේ හැටියට TP එක ඇදලා තියෙනවා හරියටම මෙතන guys. okay. විශ්වාස කරන්න නෑ ඔයගොල්ලෝ. මෙන්න TP එක ඇදලා තියෙනවා. එතකොට මෙතනින් අපි buy කරනවා. okay. මෙතනින් buy කරන සිනාරියෝ එකක් තියෙන්නේ. okay. සිනාරියෝ එකක් ඊට පස්සේ buy කරාට පස්සේ okay. මගේ ඇනලයිස් හිතාගන්න බැරි ඇනලයිස් guys මගේ හරිය. මෙතනින් අපි buy කරා මෙතනින් short කරනවා guys. අනිවාර්ය ෂෝට් කරන්න ඕනේ ස්විං ට්‍රේඩ් වල. ස්විං ට්‍රේඩ් වල එක සිග්නල් එකක් දැක්කොත් මේ වගේ අපි ෂෝට් කරන්න ඕනේ. මේ තියෙන්නේ ස්විං ට්‍රේඩ් එකේ 4 hours එකේ BTC එකේ සිග්නල් එක guys. මෙතනින් අර කූම්බිය එකේ කෝල් එකක් එද්දි කෝල් එක ආන්සර් කරන්න කියන්නේ ඒ වගේ තමයි. මේ එක ඩොට් එකක් ඇති ඔයාලා ලොස් කරන්න ටිස් ගාලා පල්ලයට එන්න හරි. ඉතින් බලන්න මෙතනින් පස්සේ හරියටම ෂෝට් වෙලා තියෙනවා. okay thing guys. okay
Several key factors affect the price of gold, influencing its appeal as an investment and its market performance. One of the primary factors is the movement of the US dollar.
guys.
Since gold is typically priced in dollars, a stronger dollar makes gold more expensive for buyers using other currencies, thereby reducing demand. Conversely, a weaker dollar tends to make gold more affordable and attractive, driving up demand and, consequently, its price. Another significant factor is inflation. Gold is often considered a hedge against inflation. When inflation rates rise, the purchasing power of money declines, making gold a more appealing store of value. Investors turn to gold during periods of high inflation to preserve their wealth, leading to increased demand and higher prices. On the other hand, when inflation is low and stable, the urgency to invest in gold diminishes. Geopolitical tensions and economic uncertainty also play crucial roles in determining gold prices. During times of political instability, conflict, or economic crises, investors seek safe haven assets like gold to protect their investments from potential losses in other markets. This flight to safety typically results in a surge in gold prices. For example, escalating conflicts or significant political events can drive investors towards gold, causing a spike in its value. Additionally, interest rates set by central banks influence gold prices. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold, making it more attractive to investors. Conversely, higher interest rates increase the attractiveness of yield-bearing investments over gold, leading to a potential decrease in its price. Decisions and outlooks from central banks, particularly the Federal Reserve, are closely monitored by the market for indications of future interest rate policies. Lastly, supply and demand dynamics are fundamental to the price of gold. Gold production from mines, recycling of old gold, and central bank activities in buying or selling gold reserves all impact the available supply. On the demand side, jewelry consumption, industrial use, and investment demand are critical factors. Any significant changes in these areas can lead to fluctuations in gold prices. For instance, a decline in gold production or an increase in jewelry demand from major markets like India and China can drive prices higher. In summary, the price of gold is influenced by a complex interplay of factors including the strength of the US dollar, inflation rates, geopolitical and economic uncertainties, interest rates, and supply and demand dynamics. Investors must consider all these elements when making decisions about gold investments.
Gold මේ ස්විං ට්‍රේඩ් එකේ බලන්න මාකට් එකේ කීයෙන්ද පම්පුනේ කියලා. සිග්නල් එක අපි ගාව තියෙන පම්පෙච්ච පම්පිල්ල. ඉතින් කෝටි ගාණක් හොයන්න තිබ්බා මේ ඇත්තටම මෙතනින් අරන් තිබ්බන ට්‍රේඩ් එක. අන්න ඒකයි ස්විං ට්‍රේඩ් වල තියෙන වටිනාකම කෝටි ගාණක් ගන්න තිබ්බා මෙතනින් බයි කරලා තිබ්බනම් ඒ කියන්නේ 3320 ඕකේ ගෝල්ඩ් එක බයි කරලා තිබ්බනම් එක දිගට බයි. මෙතන රීඑන්ට්‍රි එකක් තියෙනවා ආයෙත් බයි. මේ 4 එකක් ඉන්නේ විශ්වාස කරන්නේ guys ඔයගොල්ලෝ සුපර් අන්න. ඉතින් හරි. එතකොට sale එක ඉතින් thank you very much guys. හිටියට මාත් එක්ක journey එකේ hidden secret මගේ වීඩියෝ බැලුවා නම් guys එල බලාගෙන මේ ඔය මගේ තියෙන ඔය TikTok එකේ වීඩියෝස් තියෙනවනේ ඔය indicators ඒවා ඒ කියන්නේ education purpose only ඒවා reprint වෙනවා ගොඩක් indicators okay gold buy කරනවා gold buy වලට පරක්කු වැඩි gold buy එකට පරක්කු වැඩි scalping නම්
Our expert advisor is in action.
හරිද scalping නම් මට පොඩ්ඩක් බලන්න වෙනවා පොඩ්ඩකින් scalping ද swing trade ද කියන්නේ මොකක්ද scalping ද swing trade ද gold buy signal එක මාරු okay thank you very much ඔව් මේක සුපිරි signal එක මේක buy signal එක මේ හරිද බලාගෙන හැබැයි මේ buy එකේ හැටියට okay මේ buy එකේ හැටියට 1 minute යනවා වාගාව තියෙනනේ ඉන්ඩිකේටර් ඒතකොට වා ගත්තද මගේ ඉන්ඩිකේටර් මට මතක හැටියට එහෙනම් මේ guys මේ හරිද sorry මේ ඉතින් මේ බලන්නනේ මම live එකේ ඉන්නේ ඉතින් මල්ලි කෙනෙක් අයියේ අද දානවද මට ඉන්ඩිකේටර් එක group එකයි add කරනවද ඉතින් guys මට එල payment කරලා තියෙනවා දැන් ඔන්න payment එක okay $100 ඉතින්
Selecting the best technical indicator for gold trading can significantly enhance a trader's ability to make informed decisions and optimize returns. One of the most effective and widely used technical indicators for gold trading is the Relative Strength Index, RSI. The RSI is a momentum oscillator that measures the speed and change of price movements, oscillating between 0 and 100. It is typically used to identify overbought or oversold conditions in the market, with readings above 70 indicating overbought conditions and readings below 30 indicating oversold conditions. The RSI is particularly useful for gold trading due to its ability to highlight potential reversal points. Gold, being a highly volatile asset, often experiences rapid price movements. By using the RSI, traders can identify when gold is potentially due for a correction after a significant price surge or drop. For example, if the RSI indicates that gold is overbought, traders might anticipate a price pullback and consider selling or taking short positions. Conversely, if the RSI shows that gold is oversold, it could be a signal to buy or take long positions in anticipation of a price rebound. Another valuable technical indicator for gold trading is the Moving Average Convergence Divergence, MACD. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. It consists of the MACD line, the signal line, and the histogram. When the MACD line crosses above the signal line, it generates a bullish signal, suggesting it may be a good time to buy. When the MACD line crosses below the signal line, it generates a bearish signal, suggesting it may be a good time to sell. The MACD is effective in identifying trend reversals and the strength of a trend, which is crucial for trading in the volatile gold market. Additionally, Bollinger Bands can be an excellent tool for gold traders. Bollinger Bands consist of a middle band, usually a simple moving average, and two outer bands, standard deviations from the moving average. These bands expand and contract based on market volatility. When gold prices move closer to the upper band, the metal might be overbought, and when prices move closer to the lower band, it might be oversold. This helps traders to visualize price volatility and identify potential entry and exit points. Finally, combining multiple indicators can often yield the best results. For instance, using the RSI in conjunction with the MACD can provide a more comprehensive view of the market. If both indicators simultaneously signal a reversal or a continuation of a trend, it can strengthen a trader's confidence in their trading decision. Moreover, incorporating indicators like Bollinger Bands can add another layer of insight, especially in identifying volatility and potential breakout points. In conclusion, while the RSI, MACD, and Bollinger Bands each have their strengths, the best approach often involves combining these indicators to gain a more nuanced understanding of gold's price movements. This multi-indicator strategy can help traders navigate the inherent volatility of the gold market, making more informed and profitable trading decisions.
VIP signal තම මේක use කරන්නේ. Okay, Europe කට්ටිය තමයි මගෙන් මේක ගන්නෙ. Okay. සාමාන්‍යයෙන් ඔය ලොකු කියන්නේ traders ලා කියන්නේ යාලා VIP signal දෙනවනේ. කියන්නේ ලොකු fan base එකක් ඉද්දි මම නම් දෙන්නේ නැහැ guys. ඒක බොරු කියන්න එපා. බොරු කියන්න හොඳ නෑ. ඒයි දන්නවා මට කුණාර පාය ගන්න බෑ VIP signal එක මොකද market guys අනිත් පැත්ත හැරෙන්න දැන් මම දන්නවා. Okay. මාකට් අනිත් පැත්ත හැරෙනවා නම් මම දන්නවා. ඉතින් ඔක්කොම දන්නේ නැහැ. මට තාමත් VIP මේ VIP සිග්නල් ඔක්කොම ලාන VIP සිග්නල් අයියා දෙනවද ඉතින් මට දෙන්න තිබ්බා. හරි. මට දෙන්න තිබ්බා ඔන්න TP ගන්න. හරි ලේසි. හරි. මෙතන එවන සේල් එකක් දුන්නා නම් ෆස්ට් TP එක ගන්න. එහෙම බෑනේ. නිකන් හරි මෙතනට ලප් එකක් ගැහුවොත් ඉවරනේ. ඉතින් අම්මා තාත්තා මතක් කරලා නිකන් හරි. ඉතින් guys එහෙනම් good night. Sorry. Okay guys අපි හෙට හම්බෙමු. හරි. Good luck.
Low